Hi. With property prices rising faster than most people can save, many homeowners feel stuck. Buying a second property, upgrading to a larger home, or investing has become harder, not because they can't afford the monthly payments, but because coming up with the down payment is the challenge. So, more and more homeowners are turning to one strategy, using the equity in their current home to fund their next purchase. And while using equity can absolutely work, it comes with very real risks that you need to understand before moving forward. When you take equity out, your mortgage balance goes up, often by hundreds of thousands of dollars. That means higher long term interest costs, a longer payoff period, and a bigger monthly obligation. Even if the new payment feels manageable today, the total amount you'll pay over the life of the mortgage can increase dramatically. Now, any debt you move into your mortgage becomes secured by your home. So if you're pulling equity to invest, renovate, or buy another property, remember, you must stay on top of payments. Missed payments carry higher consequences. Your home is now tied directly to this new debt. This turns previously unsecured or less risky obligations into something much more serious. Another way a lot of homeowners use equity is to invest, and that can work. But whether you're buying another property, shares, or ETFs, investing in a startup, or funding a side business, those investments can drop in value. Markets shift, renters move out, businesses slow down, startups fail. And even if the investment underperforms, your mortgage payment stays the same because the lenders are not sharing any of the risk with you. And of course, timing matters. If you pull equity when rates are high, markets are uncertain, or property values are fluctuating, you could end up holding much more debt with very little reward. The biggest danger, you increase your mortgage expecting the investment to pay you back, but it doesn't. Now you're carrying more debt without the return you counted on. Lastly, your ability to refinance or renew your mortgage in the future depends on your income. For self employed buyers, commission earners, or anyone with a variable income, this is a major risk. If your income drops, fluctuates, or becomes harder to verify, qualifying for future refinancing becomes difficult. Your debt load may limit your options, and the amount of equity you took out could work against you later. Using home equity can be a smart financial move, but only when it's done strategically and with a clear plan. Before you take equity out, ask yourself, am I comfortable carrying this debt long term? What happens if interest rates rise or my income changes? Can I still afford the payments if the investment doesn't perform? Do I have a backup plan? And most importantly, does my monthly budget pass a rigorous stress test that includes higher rates, unexpected expenses, and potential drops in income? Home equity can open doors, but it can also increase risk. If you want clarity on whether refinancing or pulling equity makes sense for you, I'm here to help you run the numbers. Until then, here's to high hopes and low rates.